Price earnings multiple, key metric in investment valuation. Exploring a vital tool for investors' decisions. Agenda. Introduction to price earnings multiple. Calculation of price earnings multiple. Factors affecting price earnings multiple. Interpreting price earnings multiple application in investment decisions. Introduction to price earnings multiple. The price earnings multiple is a critical financial metric used to assess company value as perceived by investors. Market price per share. Calculated by the current stock price, this figure is essential for determining the price earnings multiple. Earnings per share, EPS. Earnings per share is a company's profit divided by its number of outstanding shares, crucial for this ratio. Investor expectations. The price earnings ratio reflects investor expectations regarding a company's future growth and profitability. Importance in stock valuation. Understanding PE ratio. PE ratio indicates how much investors are willing to pay per dollar of earnings. It helps gauge stock valuation. Valuation insights. Investors use the PE multiple to determine if stocks are overvalued or undervalued, guiding their investment strategies. Industry comparisons. The PE ratio allows comparison of companies within the same industry, aiding better investment decisions. Formula and components. Price earnings formula. Price earnings PE ratio is calculated by dividing the market price per share by the earnings per share. Market price component. The market price reflects investor sentiment and expectations regarding the company's future performance. Earnings component. Earnings indicate a company's profitability and are crucial for calculating the PE ratio. Sources of data for calculation. Financial statements. Financial statements provide essential data for calculating the PE multiple, showcasing a company's earnings and financial health. Market reports. Market reports offer insights and data on market trends necessary for accurate PE multiple calculations. Stock exchanges. Stock exchanges are vital sources of real-time data, enabling investors to calculate the PE multiple effectively. Factors affecting price earnings multiple. Earnings growth. Importance of earnings growth. Earnings growth significantly influences a company's PE multiple, reflecting investor confidence and future profitability expectations. High PE multiples. Companies with strong projected earnings growth often command higher PE multiples, indicating higher investor valuation. Investor expectations. Investors consider future profitability when evaluating PE multiples, leading to increased market interest in growth firms. Market conditions, economic stability. Economic stability is crucial as it influences investor confidence and market performance. Stable economies tend to have higher PE multiples. Investor sentiment. Investor sentiment plays a critical role in determining market conditions. Positive sentiment can lead to higher PE ratios in bullish markets. Bullish markets. In bullish markets, increased investor optimism often results in elevated PE ratios, reflecting high expectations for future growth. Industry and sector influences. Understanding PE multiples. Price to earnings multiples vary by industry and provide insights into investment valuations. Industry benchmarks. Investors rely on industry benchmarks to assess a company's PE ratio against its peers. Valuation context. Contextual understanding of PE ratios aids in making informed investment decisions. High versus low PE multiples. Understanding high PE multiples. High PE multiples may indicate overvaluation or expectations of significant future growth from investors. Implications of low PE multiples. Low PE multiples could suggest undervaluation or a lack of growth prospects, warranting further analysis. Importance of PE analysis. Understanding PE multiples is crucial for effective stock analysis and making informed investment decisions. Comparing PE multiples across companies, industry comparison. Comparing PE multiples across companies in the same industry allows for a more accurate assessment of valuation. Peer group analysis. Analyzing peer groups helps to identify trends and valuation discrepancies among similar companies. Investment opportunities. Identifying potential investment opportunities requires understanding PE multiples and their implications for company valuations. Limitations and potential pitfalls affected by accounting practices. The PE multiple can be influenced by different accounting methods, leading to inconsistencies in valuations. Ignores growth rates. This metric does not take into account the growth rates of a company, which can mislead investors. Cautious reliance. Investors should not rely solely on the PE multiple. A comprehensive analysis is essential for sound decision making. Identifying undervalued and overvalued stocks. PE ratio analysis. Analyzing price to earnings ratios helps investors gauge a stock's value compared to its earnings potential. Identifying undervalued stocks. Investors can spot undervalued stocks by comparing PE ratios to industry averages, indicating potential investment opportunities. Identifying overvalued stocks. Conversely, identifying overvalued stocks involves recognizing PE ratios that exceed market norms, signaling caution for investors. Using fundamental analysis, understanding PE ratio. The PE ratio reflects how much investors are willing to pay for a dollar of earnings, critical for assessing value. Investment strategy guidance. The PE multiple assists investors in developing strategies based on market valuation and earnings expectations. Integrating PE multiple with other financial metrics. Holistic valuation approach. Investors should not rely solely on the PE multiple, but consider a variety of metrics for a complete assessment of a company's value. Price to book ratio. The price to book ratio can provide additional insights into a company's asset valuation compared to its market price, enhancing the investment decision process. Return on equity. Return on equity offers a perspective on how effectively a company uses shareholders' equity to generate profits, a critical factor in valuation. Conclusion. Understanding price earnings ratio. Price earnings ratio is crucial for assessing the value of a stock relative to its earnings, helping investors gauge potential profitability. Informed investment decisions. By grasping the price earnings multiple, investors can make informed choices, minimizing risks and maximizing returns in their portfolios. Enhancing investment strategies. Understanding the calculations and applications of the price earnings multiple allows investors to refine their investment strategies effectively. Thank you.